Hello everyone, welcome back to another edition of #AskRobco. Happy Wednesday, hope you're all healthy, safe and well. Welcome to James, welcome to our special guest Toby Nicholson from LR Alternatives, our build-to-rent specialist. We will be introducing him soon and having a really exciting Q&A on his specialism as a market leader in that space. So welcome to the both of you.
Good afternoon, everyone.
Great to have you. So another week, #AskRobco, second week of 2020 in terms of our sales data and intel. Just want to share with you what's been happening on the ground. I would say it's been a relatively slow start to 2021. What do I mean by that? I think because we're in lockdown 3 and it's January, so the time of the year, we're not seeing the rush of transactions that was taking place at the back end of 2020 with the huge volume of numbers that we were seeing proceeding. So it's given the opportunity for the market, and I would say for conveyancers, from the valuers, from the mortgage product team, from the sanctioners and the credit and the risk teams, to get all of the transactions that have come over from 2020 into 2021 through. So the pressure and the intensity that there was before Christmas isn't there at the moment, and we are seeing, I would say, a slow introduction to 2021. At the same time, January is a notoriously quiet month at the beginning, so it's very seasonal. And as the weeks go by, things do get busier and busier. So if you want to go to handout 1, let's just see what the numbers look like at the beginning of 2021. So on your right-hand side, you've got the details and the data for the handouts. So we're 2 weeks into 2021, and we're just going to look at some very brief headline information. So week 2, new instructions. At the moment, we're averaging around the 200 mark. And if you remember back to last year's data, and I've left it as handout 2, so if you want to look at last year's data of how it closed out, that's on the handout number 2, we were probably getting on average 500 new instructions really consistently all the way up until lockdown 2, and then the numbers came in. So we're well off the 500 that we were seeing last year, especially throughout September, October, November. And I imagine that we will see pickup as the rest of January moves. So I think that 239 will go higher. At the same time, we're not going to return to the volumes of what we were seeing in September, October, November until the end of this lockdown. And at the moment, we're going to base the end of lockdown to be the second week in February. So although the numbers are reducing in terms of COVID numbers, they're not at levels that the government will feel safe enough to change the current lockdown. And at the moment, I believe they're still going to be targeting the second week in February. So what we're going to see is instruction levels will slowly increase because the market is open for business. But having spoken to all of the agents that we deal with and the conveyancers that we deal with, the pipeline is being managed. So we're going to move on to sales in a minute. The pipeline of transactions is being managed, but the new stock coming on stream that always starts with the new instructions is much slower at this moment in time. And that is going to take 3 or 4 weeks, and lockdown 3 coming to an end to really open up the market again. And then we're going to see the numbers return to where they were pre-Christmas. So let's move on to the sold figures. If you remember, we were constantly 200 plus every week up until Christmas, and then the week before Christmas, it was more or less a 4 or 5 year high in hitting over 300. And if you move to the bottom of our stats and data, we've got the last 4 years figures and the averages across the years. Never did we reach such a level that we saw in that week before Christmas. So obviously those numbers weren't gonna carry on, because that was a one-off week and the highest performing week in the year. We're now up to 177 over the last week, which is a good solid number, and we'll probably break the 200 in the coming weeks, and we would expect that to continuously grow. And as I said, when more stock comes on stream and the lockdown is finished, I expect those numbers to increase. Then we have the question that you continuously ask every week in terms of the stamp duty. Are we going to be falling off a cliff because of it? Is there going to be new government stimulus? Again, it's a wait and see. And I think we're going to be fed that information when the government gets comfortable that it's got the position of COVID under control and the vaccinations have reached a certain number. Then they're probably going to release information about what they're going to do with the stamp duty holiday stroke window period, whether it will continue, whether it won't, whether there'll be new stimulus, and we will just have to continue and follow the data and wait to see what happens there. James, what have you got over and beyond of what I just covered?
Yes, thank you, Rob, for that. So it's been a steady start to 2021 with new instruction levels down from what they were in the final quarter of 2020. It's going to be sort of a gradual increase in momentum, we hope, coming into 2021. At the moment, I believe it's those sellers which are the most motivated, which are launching their properties to the market, as those more cautious sellers don't want to see their property maybe sitting on the market for the first quarter of 2021. As you say, the levels of sales has been it's been good. We've been approaching the 200 mark, and that's where we were for the final quarter, more every week of 2020. It's going to be some interesting trends. Is super prime central London going to continue its upward trend and build on its record year of 2020? So that'll be an interesting one to watch.
Yeah, thank you for that. Lots of questions have been coming in over the last week and since we've been live again in 2021, and lots of areas of discussion that we want to touch, and some of those have been on subsectors and hot topics. One of them today that we're going to go into good detail with our special guest is going to be the build to rent space. We've also got subsectors around commercial markets, which are high street, HMO, student accommodation, home care accommodation. So some subsectors that over time we'd like to look into. Nurseries, retirement living, lots of different subsectors in the lending market that lenders and sales teams want to know how attractive they are. Also, like James mentioned, the super prime space, which is one that we're all over and super hot on, and that market is really robust and strong at the moment. And what we're seeing is there's a lot of secret buyers out there where a lot of the information isn't hitting the core data, isn't hitting the land registry, and isn't possibly hitting all of the agents as well. And we're noticing a trend of the percentage of those transactions that are going through that aren't being captured. And I think that's a really interesting piece, and that's a real reflection of what we're seeing in the volume of activity in that space. And then there's the lending market of alternative banks, challenger banks, high street lenders, boutique, private banking lenders, all of that space. Some people are retrenching and seeing where the markets are going. Others are really putting money out in the market because they know what their niches are. They know they're strong in HMOs, so that's where they're really bringing product. Some of them are really strong also in super prime or prime, so they're really putting a lot of lending out in the spaces where they're really strong and specialist. So there are so many trends at the moment, and then there's also the rental market. And what we're seeing in the rental market is possibly a new trend of people moving next to their offices so that they don't have to commute or use the underground and public transport, because maybe they have concerns again about COVID or being in tight spaces, etc. So we've just started to see a little bit of a trend of people looking for small spaces next to their offices so they can walk to their offices, whether it's in the Angel, in Islington, in the City, in Canary Wharf. It's just something we see, which I want to follow that trend as the months go by. Okay, so very, very excited. As I mentioned at the beginning of the show, today we have Toby Nicholson, build to rent absolute specialist, buying, selling, advising on all aspects of build to rent, joining us today. Welcome, Toby. Really pleased to have such an esteemed specialist within that area of the industry. I'm going to ask you some questions today, and everyone in the audience feel free to send in your Q&As. James, you're going to lead the questioning, so I'll open the floor to you two. Thank you.
Thank you, Rob, and welcome, Toby, to the show. I just wanted to start off.
Thanks for having me.
Thank you. I just wanted to start off. Build to rent is a fairly new sector, and it's been around sort of 8 to 10 years, really, in sort of the core market. Is there anything which sparked its creation?
Yeah, valid question, and I'll pick you up a little bit if I may. I'd say it's been around a while, probably a bit longer than 8 to 10. It's probably more 11, 12. And when you put it in the context of Delancey agreeing the East Village deal pre-Olympics, so it does go back a bit further. But you're right, institutional investors have been investing, I guess, consistently for 8 or 9 years since then. And in that time, the market has changed and evolved as people's understanding grows. I guess to answer the question, that there have been a few factors that have sparked that interest. In the first instance, it's well documented that as a nation, there is a shortage of good quality, well-managed rental accommodation, not just in London and the South East, but also nationally. And the BTR sector looks to address this. I guess further, as a result of this, from the investor perspective, it's seen as quite a defensive asset class due to the market dynamics. That's, of course, assuming the deals are structured correctly, as typically they'll offer steady returns, in many cases matching the liabilities of many of the pension funds who are deploying their capital in the space.
Yeah.
As well as all of that, sorry, I got a few points. As well as all of that, home ownership in many areas of the country has consistently been at its most unaffordable during this time, prompting a large amount of the population to rent for longer. And renting is now seen as more socially acceptable. Home ownership isn't everyone's aspiration any longer, really. And that is in trend now with Europe and North America. And I guess lastly, it's a bit of an obscure, perhaps more social point. In addition, we're very much a streaming and renting world now. We rent our music, our movies, our cartoons, our books, our cars, our bikes, and ultimately renting your home is, given the quality has increased an awful lot, is an accepted thing.
Yeah, no, thank you for that, Toby. It's interesting how, Boris Johnson, in some of his messages he's given out, has coined it sort of generation rent, and it's going to be interesting how that maybe switches to his generation buy, which he's mooting. Just a quick one. The future of the industry, do we see any changes in that just moving forward? And maybe you could just give us a snippet of some of the largest deals in the last 12 months.
Yeah, sure thing. There's nothing quite like being put on the spot with the future of the industry, but I'll give a few taster points and probably highlight two areas for the purposes of this chat. Firstly, due to viability challenges, I can see there being more land and JV-led projects. But by this, I mean landowners staying in the deal for longer, with developer contractors, partnering with them to share the upside with those landowners. That's an area where I'm exploring, and we're exploring with others at the moment. And that's quite interesting. And the second area, and it's wrought with red tape, obviously, but public and private partnerships. And I'm seeing this as an area that will potentially kickstart certain sites that are on paper challenged, and ultimately many local authorities are often desperate to deliver more homes than their boroughs currently have. So this is a way to really affect change. In terms of the deals, I'm going to highlight 3 deals, coincidentally, that I've been involved in, but also one deal that I wasn't involved in that didn't happen, and you may or may not be aware, but I'll come on to that last. So, yes, the market is embryonic, as we've touched on, but Gatehouse Bank have been quietly going about their business, and they've got 2 funds. The first fund, which is named Thistle, sold a fortnight or so ago. That was 900 houses in the Midlands and the North, across 15 sites, and the GDV of that was 150 million. So that's an example of an operational portfolio that sold recently. The other 2 I'm going to mention are forward fund projects. And in East Croydon, I brokered the funding of Morello Quarter. It's a 450 apartments, 20,000 square foot of retail, a new station and a new bridge link to that station that led directly into the scheme. Pretty big infrastructure project involving a lot of stakeholders, reasonably complex, and took about 2.5-3 years to actually put together. The GDV on that was about 250 million when you factor in the station and the bridge. But the private build to rent, which was about 340 units, that was about 130 million.
Okay.
That's a London example. Another deal that I brokered was in Manchester. That's with Pension Insurance Corporation and Muse Developments. Again, a forward fund, 520 apartments and 130 million. So they're both highlight deals, one in the north, one in London and the south. And I thought, just for general rounded purposes, to give an insight into one of the biggest deals that didn't happen, and that is the well-publicised sale of Quintain, that I think, if I'm not mistaken, failed to transact and was pulled from the market only a few weeks ago. So a bit of positive and a bit of negative there for me.
Just on that one, Toby, that's the Wembley
Sure.
deal that's much publicised. Good that you mentioned one of our clients, Gatehouse Bank. Well, that wasn't scripted, but good that you're doing a deal with them. We work very closely with, whether it's mainstream banks, funds, the high street, private banks, challenger banks, bridging lenders as well. And if they're looking at this stream of investment as alternative lending, and maybe they haven't stepped over the line yet because they want more conventional, buy-to-let portfolio, HMO, more mainstream rental investment products, maybe you could share with us the visions of the market in the next 5 or 10 years as it opens out and as those lenders that haven't crossed the line yet start embracing.
Yeah, it's with Gatehouse. It's not actually, well, they did put some of their own money into that first fund, but it's more putting other people's money, deploying that, delivering them an income return, and in this case, a fair bit of yield compression to contribute to the whole investment return for that fund. So ultimately, it's seen as a steady income return, as well as a capital growth play as well.
Yeah, thank you for that. Just going back to some of your examples of the last 12 to 18 months, those deals, it's interesting geographically to see the changes in some of the housing stock. The model really works both in the urban areas of cities and in the Midlands. I noticed that you said 900 houses rather than flats. So that's an interesting dynamic for everyone to appreciate. Just moving forward, it's going to be interesting with sort of those pressures of people moving out of cities and urban migration, to whether there'll be more placemaking moving forward in some of these schemes, more outside space and public realm, maybe sort of one to watch as we see it move forward.
Yeah, no, absolutely. Yeah.
Sorry, go on, Toby.
Sorry. Yeah, no, I agree.
Just moving forward, it's obviously been sort of quite a testing 12 months in the for student housing operators, which is an industry quite closely aligned to build to rent. Have build to rent operators been hit by any of those voids, those similar voids, been affected at all?
Yes, it's been challenging, and it's put a lot of investors and a lot of the investors operator partners, under a bit of pressure. Key areas of challenge of leasing velocity has slowed. Certain schemes have suffered increased voids, and a number of my clients are having to consider payment plans for tenants or clients of theirs who have been put on furlough or suffered redundancy. But what it's really done is really highlighted the need and benefit of proactively designed schemes, apartment schemes, with amenity, with management in place, outside space, crucially, compared to a scheme designed for the sales market that doesn't have the same thought to the actual building, the longevity of that building, and really who's going to live in that building in the long term.
Yeah, no, thank you for that. And I know you mentioned some yield compression on some of your deals in the last 12 months. I don't know if you can just talk us through briefly how the sort of gross and net yields have shifted in the last few years, and what sort of typical returns are sought by the operators and developers at present.
Yeah, sure thing. I'd say that the yield shift has happened over a number of years rather than on the specific deals, but high level wise, stabilized apartment yields in the last 12-18 months have probably come down from 4% to around 3%, 3.25%. Stabilized housing yields have probably come from a net, there's a net, by the way, net of around 5.25% to around 4.25%, if the rumours to be believed about the Gatehouse portfolio that we've already mentioned. In terms of the returns that investors typically seek, ungeared IRRs are probably around 5 to 6%, whereas previously they were 7 to 8%. So you'll notice that at those low levels, it really is patient capital looking for steady income return, rather than those seeking double-digit lumpy returns. And that's testament to the investors who are in the space and the different risk appetites that each of them have. Each different one have.
Okay, no, thank you for that. I mean, maybe there's a long-term view. Is there sort of longer-term capital appreciation of some of the schemes, with obviously their sort of steady and reliable income being a premium for those investors?
Yeah, exactly that.
Okay, great.
Just on that point, how much rental growth is being built into those schemes over the years, if any, and is there any kind of void or occupancy rates at the moment that you're finding that the schemes are being challenged by?
Yeah, I mean, so when I model a build to rent scheme, it'll be over a 10-year period, and depending on what is forecast over that 10-year period, we'll input it on an annual basis. For example, last year it might have a 0. This year it might have a 0 too. Who knows? We haven't got a crystal ball. But long term, it's more kind of you know, 2.5 to 3.5 over the course of a 10-year hold. But what you might find some factor in is, yes, we've had a low growth last year, or not as much growth last year, and probably depressed growth this year, but you might have a bounce back next year, and you might have factor in a 5%, you know, but ultimately, you know, we can touch on that a bit later. But was there another aspect to your question,
Yeah, the
Rob?
second part was just occupancy levels and void periods.
Yeah, so in the modelling, when I do a model, we'd factor in between 23 and 25% gross to net management, maintenance, and void costs, and that's quite a standard figure. The bigger the scheme, the bigger the apartment scheme, the more opportunity, if it is designed right, to bring that management cost down. Management of houses is lower, and that's at and around perhaps a little below 20. In those numbers, in both cases, the void rate is between 2 and 3%, which is, you know, I think a general accepted norm. Now, if you read the Gatehouse press release from a week or so ago, I think their void rate was 2%, or, you know, under 2%, which is testament to the quality of their assets and the way they've proactively managed it, really. You know, noting, of course, that their sites, you know, between 50 and 80 units, or 50 and 80 homes per site, which is perhaps more straightforward to manage than if you've got 500 apartments in a single block. It's different, you know, different metrics.
Yeah, no, thank you for that, Toby. So we're looking at sort of 20 to 25% operating costs of those blocks, which obviously includes a void built in, as you mentioned, possibly the management fees, the reletting fees, some sort of sinking fund, I imagine, in there.
Yeah.
Just to give everyone a flavour of what those operators' costs are made up of. Just moving on, who are the main players in the industry, and is there any particular operators which differentiate themselves from one another?
Sure. Bit of a warning. That's quite a broad question.
Yeah.
But I've tried to summarise it to break it down, and I'd observed that there are, I guess, 4 main groups, and I'm going to give a brief overview of each. Summarises the straight investors. Secondly, developers and investors who can develop, but also are long-term investors, the house builders and the contractors. Now, on the first one, straight investors, for example, the likes of M&G, L&G, PIC, you know, Gatehouse, MEC, and Granger. Those guys don't take any development risk. They need a rock-solid contracting developer and contractor to partner with, and their returns are characterized by low cost of capital and low yields. Investors who can also take development risk. So those are the types who are comfortable with planning, comfortable with development and construction risk, as well as the medium to long-term operational risk, and which captures an increased level of return for taking that risk. Example of guys who are in that space are the Grangers as well, L&G again, Greystar, and Cortland. Those guys can take that whole spectrum of risk. It's worth touching on the house builders, but it is rare that they rarely take a proactive approach to developing build to rent, as simply it's against their core business of selling apartments and selling houses. You know, if they've got a 20% or more profit on revenue target, it makes it very viability challenged, and it often struggles to stack up. But, you know, without wanting to be too negative, the guys who have done deals in the past are the likes of Crest, Bellway, Barrett, Telford Homes, before they had a refocus on more the delivery side. It's important to note on these that it's a for sale building, a building that's been designed for the sale market that is being rented. So often they don't have a management space, amenity space, and are not proactively designed for the build-to-rent market. Now that does, I think, have a long-term impact on the performance of that building, and it's testing times like during the COVID pandemic that, you know, I question whether those, you know, may not have performed as well. Who knows? Lastly, I'm going to touch on contractors, and in a forward fund, it's the contractors who often have to bear the majority of the delivery risk. So there's some of them have started to use that expertise to their advantage to take slightly more return than they would have done if they were just solely the contractor. Those who have done it in the past and, you know, continue to explore it are the likes of Balfour Beatty, NG, Vistry, Telford, and Watkin Jones. All of those guys are pretty proactive. So sorry for rabbiting on, but it was quite a broad question. It's, you know, I'd say there were four different categories of players in the or groups in the sector.
Yeah, no, thank you for that, Toby.
We've got 2 more questions left. I think we're going to overrun by about 2 or 3 minutes. I really appreciate your extra time, Toby. One quick question on valuation, and I'm going to leave the last question to James. And what are your thoughts on AVMs within the models and being used, whether currently or in the future, in terms of build-to-rent schemes?
Sorry, AVN, can you elaborate? I'm not sure. It's not an acronym.
Automated valuation modeling used within.
Yeah, I don't think that works. In fact, I'd go so far as to say it categorically won't work. It's every scheme is so bespoke that it's not possible just to have one model that fits all. Frustratingly for me, it's new scheme, new model. But that's such is life.
So I think that goes in the area of all specialisms. So when you're a specialist like you are, or like we are in a lot of the areas that we work in, it just means everyone can't do it to either the level that you can do it because you've got the 10, 15 years market specialist knowledge to be able to then share that with your client. And that's the same as every specialist within the industry, and the lenders who are specialists within the areas, and the funds that work in their areas, they're specialists for a reason, which is why everyone can't do it. So I think it's a brilliant point, and it's why real estate, property, the built environment is such an amazing place to work, whether you're on the lending side, the risk side, sales side, and at the same time, there are so many nuances within it to find your place. Last question for today, James.
Thanks, Rob. Thanks, Toby. Just a final question. I'm sure in a lot of these models, similar to other developments, there's some sensitivity analysis done. I was just wondering, and it might be very scheme dependent, but it was just whether there was a certain level of occupancy required for a scheme to be viable. Is there any sort of sensitivities done there in some of the modelling?
Look, I think that what we do is work on a basis of 100%, and then within our management maintenance cost, assume 3% void. It's no more complex than that at the moment. But for it to be viable, it's going to have to be. It can't be a lot less, if that's the question. Yeah, 90% plus. You know, 90% plus, and you. The point is that you can't have consistently under that amount of occupancy. Granted, of course, during the initial lease up, it would, it takes a while to lease to 500 apartments, but between 90 and 100% occupancy, really, and realistically, I can't see many blocks over a long-term sustained period being less than 95% occupied.
Yeah. Okay. No. Well, thank you very much for your time today, Toby, and some of your insight and expertise into the industry.
No problem at all.
Great knowledge, great experience, great specialist area. Anyone that has more questions for Toby, please reach out to us. Anyone that has questions for us, please reach out. We haven't got through all your questions this week, so everyone that was waiting to hear about product pricing within the marketplace. We'll take that forward to next week. We're sure you will give you those updates. We'll go into more detail next week on product and pricing and where the lending market is with the high streets versus the challengers. We'll go into more detail. And next week, we'll have the latest market intel data on the ground of what we're seeing, and we will be sharing it with you, same time, same place, every week. Hashtag askrobco every Wednesday, 1 p.m. Thank you for following us on all of the platforms. Thanks for all of your input. Super grateful. And we will see you all the same time, same place next week. Thanks, James. Thanks, Toby.
Thanks, guys. Take it easy.